All right, so that's kind of where the market's been, where it's at. Certainly some challenges where we're seeing sales fall, we're seeing values fall. There's still some challenges set to come through on the official cash rate, on inflation, on mortgage rates. So there is just a sort of air of pessimism, I guess, floating around the property market at the moment, and certainly this downturn will roll on into next year, I think. Kind of touched on it already, but hot topic number one, I mean, lending conditions, as I said, with inflation still a problem, the official cash rate set to go up again, mortgage rates set to go up again. Credit conditions is a huge factor here. So I've got a bunch of stuff on this slide to talk about, but it's such a big feature. You know, a huge part of the upswing post-COVID was credit criteria. You could get a mortgage, it was cheap, that pushed up property values. Just like it pushed up values, we're now seeing the reverse. You know, it's hard to get a mortgage now. It costs you a lot. So we're seeing property values fall. So I think the credit environment is really important here. There are some positives and negatives as I'll again trying to bring a little bit of balance here. It's not all doom and gloom, trying to bring a bit of balance, but you certainly do have to acknowledge the negatives as well. So subheading here, I mean, the LVR rule is still really tight. If you don't have 20% as an owner occupier in terms of a deposit or 40% for an investor, really, really hard to get a mortgage still. So those LVR rules still pretty tight. Debt to income ratios, so DTIs, they're getting tighter, or at least the share of lending going out at a high DTI is getting tighter. Now, in the background, we've got the Reserve Bank's consultation on debt to income ratios. It looks pretty likely that we are going to see formal rules on debt to income ratios, basically capping how much high DTI finance can go out. It looks like those rules won't come into force for a while yet, though. So maybe early 2024, we might see some official rules from the Reserve Bank saying, for example, banks can lend, let's say, up to 20% of your lending can go out at a high DTI. So a sort of speed limit arrangement like we have at the moment with LVRs, where that cap is set, still up for grabs, where that speed limit's set, but also where the cap's set. Could it be a DTI above 7, above 6? Hard to know. The Reserve Bank seems to have indicated a DTI of 7 would be the cap. So the rules could be something like banks, you're allowed to lend up to 20% of your loans at a debt to income ratio above 7, something like that. So we have to wait and see. But whatever they do, it looks like they won't be imposing them for a while yet. There'll also be exemptions for new builds. So again, like there are exemptions for the LVR rules, there'll also be exemptions, new build exemptions under the DTI system too. So there's probably more regulation to come. We've also got mortgage rates rising. So the credit environment is still pretty tight. Just around DTIs, chart on the left-hand side here, there's also this question around DTIs, whether they'll actually be binding, because what we're already seeing is that high debt to income lending is already tightening up really, really sharply. So especially for investors. So the blue line there is showing the share of investor lending going up at a high DTI or a DTI of 7 or above. You can see that blue line has really tailed off. Go back a year or so, 35 and 40% of investor loans were done at a high DTI. Now it's sort of 10 to 15%. So that's really tightened up. Banks have tightened up. Borrowers don't want that high risk finance anymore. And also mortgage rates are higher. So you simply can't service as much debt out of a given income when interest rates are higher. So there's a bunch of factors going on here, and that's causing that high DTI finance to tighten up. So key message is it's still pretty restricted out there in terms of credit. However, there is a positive here, and you sort of got to scramble around a little bit, but there is a positive, and I think now it could change. But what we've seen in the past sort of 12 or 18 months is that this big wave of refinancing, so people coming off 1-year fixes at a lower rate and having to refinance onto a higher rate, we've actually seen that wave go through. A lot of people have refinanced, and without too much. Okay, they've had to curtail spending in other areas, but it's been manageable. So this refinancing wave is working its way through, and people seem to be coping. Just to illustrate that, on the right-hand side here, we've got the breakdown of all existing mortgages around the country. And it's the blue line, or the dark line there, that's really the interesting one. That's the share of lending that's currently fixed, but due to refinance in the next 12 months. Now, you can see going back to 2021 there, that share was really high. We had sort of 65, 70% of loans fixed and due to be repriced in a short horizon. But look what's happened. That number's come down. We're now back down to about sort of 40, 45%. Now, still high, but it's a lot lower than where it was. And it's pretty normal. If you go back through time on that chart, it's pretty normal for 40 or 50% of loans to be fixed and due to refinance within a 12-month horizon. So yeah, I just putting a little bit of a positive spin on it. You know, this refinancing wave that everyone was worried about, well, actually, it's kind of worked its way through. You know, banks have been working on it. People have been looking at their payment plans, and it's kind of worked its way through without too much trouble. So that is a positive. Now, you've got to acknowledge that there's still more to come. If we saw unemployment rise, there's still going to be some issues, and 45% still have to refinance. They're going to refinance in the next year, probably going to be looking at a higher mortgage rate. So there's still some challenges, but just wanted to point out that let's not get too gloomy here, because this refinancing wave has been working its way through and reasonably successfully. Okay, financing. I don't want to touch on this too much, but just to acknowledge that negative equity has come onto the scene. So you're probably starting to see some media headlines around negative equity. Pretty well known what it is. I mean, it's simply where the size of your mortgage is bigger than the value of your house. So you actually don't have any equity in that home. Now, a couple of points for me. It's not a huge scale yet. We've run some numbers here, which I've shown on this chart. Just looking at first-home buyers who bought at the peak of the market, who could now be in negative equity. So we've looked at the price they paid in the fourth quarter of last year and compared it to the current value of that property based on our automated valuation model. Now, the key point is these numbers are low. So if you look at, say, North Shore there's about 20 first-home buyers who could be in negative equity at the moment. So not many. And the pink bubbles there, or the pink circles, that's the percentage of first-home buyers. So in the North Shore, you might have 20 first-home buyers in negative equity, and that pink dot suggests that's maybe 5% of all first-home buyers. So it's not a huge number, and of course first-home buyers are only a proportion of the market as well. So yeah, so it's not major. Maybe a bit more stress than somewhere like Lower Hutt, consistent with what we've seen previously in terms of the weakness of that market. But key point for me is that negative equity, yes, it's starting to creep into the media headlines, but it's not a big scale yet. It's still pretty minimal, and it's not a concern if the debt's being serviced. If people are in work, they're paying that mortgage. I mean, not great for their mindset perhaps to think, gee, my mortgage is bigger than the value of my house. But if you don't have to sell, it's all on paper. You're paying the debt, the bank's not going to come knocking. So I think it would be easy for this discussion about negative equity to get carried away. For now, it's not a huge scale, and doesn't matter if you're still paying the debt. So that's the key thing. Now, there are risks, of course. If people lost their job, there are some risks. But I just think there's a chance here that we get too carried away with the pessimism. Okay, number 2, construction. Conscious of time, I'll try and keep rattling on through. Just to point out here that the new builds are definitely still popular with buyers. So we've this is buyer classification. So again, the share of purchases, but this time looking only at new builds. So not looking right across the market as a whole. And certainly buyers are still keen on new builds. If you're an investor, you can get in with that lower deposit. You can still claim your mortgage interest as a deductible expense. So big incentives for investors to look at new builds. Chart on the left here showing the breakdown or the buyer classification for new builds. Lo and behold, mortgaged MPOs, 32%. So investors still really keen on new build properties. 32% of deals going to that buyer group. As I say, lower deposits can still claim mortgage interest. First-home buyers, though, as well, really keen on new builds, 27% at the national level. So again, first-home buyers, there's no tax implications here, but first-home buyers can also access new builds with a reduced deposit. So that gives them an incentive to look at new builds as well. So yeah, still a lot of demand for new builds out there. A lot of new builds coming through, of course, but a lot of demand for them too. Switching to Auckland quickly on the right-hand side. Same thing, mortgaged investors still really keen on new builds, 32%. But look at first home buyers, they're super keen on new builds as well in Auckland, 32% too. So yeah, key point, doesn't matter really where you are, national, Auckland, Wellington, Christchurch, the rules are the same. New builds are still pretty appealing to buyers, whether it's an investor or a first home buyer. Uh, a lot of discussion around the construction sector, of course. Now, we've been in a very busy market for construction. We know that dwelling consent's been high. We know that actual building work has been high. There's been capacity pressures in the construction sector, and costs have risen. So it's been a busy market, but I think now we're simply at the point where this market will slow. So I think we're going to see reduced construction volumes in future. But it's such a high level. That's the thing, is that even as people talking about a slowdown now, but look where we're coming from. It's been super high. So I don't think people sometimes fear the construction sector going into a huge bust, which we have seen in the past. But I just don't think that's on the cards now. We're going to see a slowdown, but it's from such a high level that it'll still leave construction activity quite busy. So just to illustrate that, chart on the left here, or the only chart here, is a projection of dwelling consents from MB and brands. And you can sort of see what I've just talked about, that the purple bars there are the future or the forecast. And yet it's slowing down quite a bit, far fewer dwelling consents in future than what we've had recently. But it's a slowdown from such a high level. And if you look back through time, those purple bars are pretty much higher than anything we've had since the mid-70s. So we're going to get a slowdown, but it's certainly not that bust that we've seen in the past. And certainly, so look at after the GFC there, 2009, 2010, you can see how deep that downturn was. So we're nothing like that. So we've got a slowdown coming, less construction activity, but not as deep as what we've had in the past. And a few notes down the right-hand side here, just sort of spelling that out. I mean, the mood amongst builders, I'd still call it cautiously positive, an acceptance that the slowdown's coming, but also that it doesn't need to be as bad as what we've seen in the past. And there's a few factors. I mean, I've talked about how people still want new builds. So there's incentives there. People still want new builds. That gives developers the confidence to keep pumping them out. We've also got housing shortages. I think, most people would say we still need more properties on the ground. Maybe some fears about townhouses in Auckland, but generally there's still a concern that we don't have enough property. The government's willing to step in and support the construction sector as well. And we've had that raising of Kiwi Build price caps. So there's a lot of things in here that suggest, okay, we've got a slowdown coming for construction, but it doesn't need to be as bad as the past. So I think long term, what that does, more supply than we otherwise might have had, that will perhaps restrain house prices as well. So just another reason to think that this downturn's perhaps got a bit further to run.